Hi, everyone. Good afternoon. It's been, 2 weeks since we last spoke, with Jay, and this was just 2 days before the invasion. So, of course, a little bit has changed since then. I'm going to start with one quote, which is, there are, decades where nothing happens, and then there are weeks where decades happen. So, looks like a lot has changed. But then I'll turn to Jay because he has actually a very interesting title for the Musings, which is the perils of circle thinking. So I'll welcome him and let him explain what that means, and then we'll progress as we usually do.
Thanks, Roberto, and hello, everybody. Certainly a very challenging day in the markets, unless you were short, in which case you hopefully celebrated and maybe covered a little bit. In New York, I'm happy to say the good news is that we're really approaching spring, and it was the first day where one could go to work without wearing a heavy winter jacket. So started off pretty good and then went downhill from there. So yes, Roberto, as you mentioned, the Musings on Friday was titled "The Perils of Closed Circle Thinking." And what I meant by that was, going into this conflict, most people thought that Vladimir Putin was a master strategist. I mean, that was his reputation. That was how I kind of viewed him. And over the last 2 weeks, he's been revealed to be not a master strategist, but rather someone who was completely out of touch with the modern reality. And that's the peril of the closed circle thinking I reference in my title. Because here's a guy who is completely in a bubble, only speaks to yes men, so is getting no sense of any alternative frameworks, has no understanding of the modern power of communication and the ability of information and video to go viral around the world in the space of mere minutes. And so he has been, I believe, completely outplayed, first by President Biden in how the U.S. Opened and showed intelligence in the run-up to the war and to the beginning of the invasion, and secondly, by President Zelensky of the Ukraine, who has emerged, not, I guess, surprisingly, given that he is an actor by training, not surprisingly, a master of modern communication. And so, to me, it's really the contrast between Zelensky, in a bunker, in a foxhole with his comrades around him in military equipment and military gear, and President Putin talking to his own advisors, from a table that's got to be 20 to 25 feet long, sitting at the head of it by himself, is I think, a very stark and significant contrast. And so, we have talked a lot about speed, about the age of speed, which I believe we're in, right? We talked about COVID speed 2 years ago, climate speed a year ago, analytical speed 6 months ago, and now speed of communication. And so the ability of information to be transmitted globally has really manifested itself, and I believe has led the process here. Social media is not just reporting or distributing information. I believe it's leading the process in pushing the political class to act faster and further than it would have otherwise had. And I think that has been very clear. Let me just quote Ursula von der Leyen, who is the head of the EU.
Yeah.
European security and defense has evolved more in the last 6 days than in the last 2 decades. So President Putin is bogged down militarily in the Ukraine. He has kicked his biggest customer right where it hurts, and that customer is now exiting from reliance on Russian energy. He has unified NATO. He has led Germany to undo 20 years of defense thinking and agreeing to spend 2% of GDP on defense. So when you look across the board, it's hard to find one area at all where Russia is looking better today than it was looking 2 weeks ago.
Yeah.
And I would just note before I stop that this has big implications for our tripolar worldview, right? Our central framework, the way we look at the world at TPW Advisory, is this idea of regional deepening and regional integration in Europe, Asia, and the Americas is the way forward. And what we've seen in Europe in the last 2 weeks is significant and hard to understate how important it is, because much as COVID kind of did away with the fear of joint fiscal spending, right? All of a sudden, everybody agreed we all have to spend money, and they've spent significant amounts of money. I believe the Russian invasion of Ukraine has done the same, both in terms of national and continent-wide defense, as well as in terms of energy security. And so I expect to see a much more cohesive and integrated Europe in the next couple of years than would have occurred without this invasion. And that, to me, again, if you're anything beyond a short-term investor, if you're someone who's looking multi-year, you should really think about what the Europe of the future is going to look like. And I believe it's going to look much stronger than it would have even without this invasion.
Yeah, no, it's a great point, and we'll cover that later on. Also, given it is an important region for your portfolio allocation. We've been talking about it a lot, and there are several ways in which this strong European integration can play out, especially the energy policy. But given all of that, how do we stand now in terms of the portfolio and some of the allocations, so then we can move on?
Well, yeah, I think let's talk about the allocations towards the end. I mean, I think where do we stand now? I think it's really important, and I'll give an anecdote to that. I was on a regular call I have with some former Morgan Stanley buddies. We do it every month, and they're all, very active and experienced and senior in the markets. And I was the fourth speaker. This was last Thursday. And we go around the table and everybody gives their point of view for 5 minutes, 7 minutes, whatever. And I was the fourth speaker, but the first one to mention the word COVID. And so to me, there are two things to keep in mind beyond the day-to-day, right? It's very easy to get caught up as investors in our own closed circle and in our own day-to-day. And so to pull back a little bit from the headlines and all the uncertainty, I would think that there are two things that are really important. The first is that Russia has taken an aggressive Fed and aggressive central bank tightening off the table. And if this was the main risk, and typically it is the main risk, right? The Fed has to tighten until things break, namely the equity market, create a recession. That risk is now gone. That risk is off the table. And it was clear in Chair Powell's testimony last week. It's clear in the market pricing of 7 rate hikes, now down to 5 or 6. I continue to think it's going to be 2 or 3 rate hikes, as I've said pretty much consistently for several months now. And so that's one. The biggest risk of all, Fed risk, is off the table. The second factor that I think is likewise very important is that COVID and the ebbing of COVID and the global reopening that the end of COVID or the ebbing of COVID really means is not getting any discussion whatsoever. And to me, that is just it's understandable, but it's a complete miss by the investment community. The single biggest factor for the global economy, in my view, is that COVID is ebbing, and we are going to have a global reopening. And I quoted in my musings how Asia's PMIs are as strong as they've been in years. I referenced that China's PMIs were better than expected. I highlighted and quoted Pantheon Economics on the startling speed of the US reopening. All these things are taking place, but completely being ignored by the market. And so when I look at things that say, oh, we're back to spring of 2020 levels, or sentiment is as bad as it was in the pandemic lows, or this comment or that comment, we are in a completely different place. And so I think there's reason to be constructive. Obviously, a lot depends on the end game, and maybe that's something we should talk about now. But to me, the two biggest factors are that the aggressive Fed risk is off the table, and COVID is ebbing. In the U.S., we were having 800,000 plus cases a day, less than 2 months ago. Today, it's 40,000 cases. New York, we just completely did away with all the restrictions. You don't have to wear a mask indoors. You don't have to show a vaccination to go to a restaurant. Europe is doing the same thing. As you well know, the beginning of March, most of Europe reopened. Europe had record low unemployment.
I was in Switzerland over the last few days, and there's no restrictions anymore, unless when you go on the train. So you go on the train, you need to wear the mask, but there's no limit for people to go into restaurants or anything.
So Europe had record low unemployment in February, record low, even with the service sector being obviously operating, I don't know, half or 2/3 speed. The U.S. jobs number was way better than expected, and average hourly earnings were also better than expected. And so to me, this is the story, and it's getting no attention. And so I think I'll take a pause for a second, see if you have any questions. But I think the next thing we should touch on is, how does this Russian-Ukrainian situation end?
Yeah, no, it's a good point. So let us know what's your end game scenario, because and then we will, of course, we'll take it from there.
Well, I mean, I think the key point is, again, very well, Roberto, is that markets hate uncertainty, right? Yeah. And right now we have maximum uncertainty. And I think that no matter what the outcome is, it will remove and reduce uncertainty, which will be good for risk assets. So my feeling is, I'll just read the quote that I ended my musings with from Lawrence Friedman, who is one of the world's global authorities, leading authorities on war and international politics. And here's his quote: Putin doesn't have inordinate time to sort this out. The economic hardship is just starting to be felt. He can't let this drag on for weeks and months, which is how long sieges can go on. So time is a real problem for him. I think that's completely accurate. Russia is making no advances militarily, really, to speak of. Economically, the sanctions are much tougher and having much more of an immediate impact than I think Russia ever imagined, or Putin ever imagined. The ruble is at 139. I just checked it before I got on the session here. The ruble has more than halved in the space of 2 weeks. Russia has become a pariah state. The market itself is embargoing its energy exports. It's not the EU saying we're not going to take gas or oil. It's not even the US saying it won't take Russian gas or oil. It's the market itself saying it doesn't want Russian gas or oil, even at the biggest discounts on record. When you look at Urals oil versus Brent, the discount is a record-wide discount, and you still do not see buyers because people are afraid, given the sanctions, to take shipments, to try to ensure shipments, to try and pay for shipments. And so we have already, on a market basis, priced in over the last Friday and I believe today and over the weekend, the big worry, which is that we were going to go do without Russian energy. It's already effectively happening as we speak. The other key point is that we finally got some headlines around nuclear, right? And the concerns, I mean, Bloomberg on Friday morning, CNBC Friday morning, it was nuclear Armageddon was the Bloomberg headline, nuclear Armageddon. So obviously those are not words you hear all the time. And now they have been broached, and therefore people have been thinking and acting on that kind of worry. And so to me, I think we are very far along in the process of discounting what's likely to happen. Time is not Putin's friend, not on the battlefield, where Ukraine is being rapidly resupplied by the US and NATO and others, not politically, where he's having to arrest thousands of his own citizens on a daily basis, not economically, where the sanctions are biting and every day new companies, private sector companies pull out of Russia. So to me, I expect that in the next several weeks, we will have some sort of negotiated ceasefire. Putin has made his demands clear. He made them clear on the 5th of March. He reiterated them on over the weekend and again today. To me, he seems like a guy who is trying to find a way out. And I believe my expectation is that China is likely to play an important role here. China abstained from the UN vote on this subject. Ukraine has already said China is an acceptable intermediary. And I think Russia, if there's at all any kind of strategic thinking going on there, they are very close to becoming a vassal state, a dependency of China.
Yeah.
Because all they have left is to sell raw material to China. And China is not taking those raw materials because the same companies that would take them and ship them and store them are the ones doing the same thing with the United States and Europe. And so they would fall under sanctions. And when you look at the trade between Russia and China versus versus China and Europe and the US-European trade with China is 10 times plus more than Russia's trade with China. So I think there's very good reason to expect in the next couple of weeks a negotiated settlement of some type. And when that happens, the amount of reversals that are going to go on across assets is going to be epic. And I think one has to be thinking about that as every day passes.
And I mean, it's of course, difficult to anticipate, exactly what the settlement is going to look like. But, what would you anticipate? So Russia getting some of the things they asked for, you think the West is okay with neutrality and maybe independence of those two republics? And of course, the sanctions will stay probably where they are. They may not increase, but how do you see more or less things evolving?
Well, I mean, I'm no expert, so I don't really have like a finely detailed view of what is acceptable to either side. I think what Putin is asking for in terms of territory is what he already has.
Yeah.
He already has the Crimea, has had that since 2014. He has these separatist republics, such as they are. They are, economically destitute places. If he wants to be responsible for them, economically, I guess that's probably something that would be acceptable. I think there is definitely a resistance to the dismembering of the Ukraine. So I don't think it goes beyond that. And I think the idea of neutrality is relatively acceptable. I highly doubt demilitarization of the Ukraine would be acceptable to the Ukrainians, nor should it, given what's happened over the last 2 weeks. So obviously there's going to have to be some give and take. And I do think sanctions would be rolled back to a certain extent to provide an off-ramp for Putin and Russia. They need an off-ramp. You have to provide people with an opportunity to exit. And I think, again, I imagine those things are already being discussed and hashed out by all the different parties. And it could come together relatively quickly. And again, to me, it's not really what the details are. It's that there's a reduction of uncertainty. It's the reduction of uncertainty. The VIX has been is inverse, an inverse VIX, which typically doesn't last very long. The MOVE index, the U.S. Treasury Volatility Index, is kind of off the charts volatile.
Yeah.
Commodities have been virtually the entire complex is in backwardation in a way that's rarely, if ever, been seen before. So to me, all these things are extremely stretched. You look at the market action, it's one-way action. It's people just getting out and in a very thin market with no buyers, and price has to adjust. And you see that with things like Jets today down 10%, KRBN today down 10%, European banks down 30%, even though Morgan Stanley pointed out over the weekend that the maximum potential loss of all the European banks' exposure to Russia and the Ukraine is a fraction of what has happened in terms of the stock price. In other words, the stock price reaction is way more greater than the maximum potential loss. And so now you have the European banks trading at half of book value. I was on Bloomberg this morning, and then we had a big discussion about the European banks because I'm known and I have been a European bank bull. And believe me, we have not sold any of our position. It's been painful, but we have, a well-diversified model portfolio, both our global multi-asset and our TPW 20 thematic, both outperformed their benchmarks over the last month. And so, we're riding it out, but I think that how this actually ends is less important than that it ends.
Yeah, no, it's a great point. I mean, it's better than it ends because I think whatever most likely whatever consequence we have of this, probably the markets have already priced in. And then there's another quote in the market, a famous one. I don't know who made it, or it's something people repeat from time to time, is that whenever we have the oil price doubling, anywhere between 12 and 24 months, the global economy goes into recession. So is that the case now too? And how if that's a powerful force, how does that go against the issue of the reopening? So we have two forces going against each other.
Yes, and it's a great question, and it's one that I've been asked a couple of times over the last few days, and as well again this morning on Bloomberg. So you might have a side hustle, Roberto, as being a Bloomberg anchor, if your own job doesn't keep you busy enough. So I think that my first point would be that the global economy currently, as of like today or the latest data, is quite strong. I mean, you never hear that from, or think that from the headlines, but if you look at, we touched on it a little bit, right? European unemployment at record lows. The most recent PMIs in Europe were quite strong. COVID is ebbing, restrictions are being lifted, service sector is going to take off. You have significant fiscal support coming through the next gen plan. The bulk of that fiscal spending is going to be this year and next year in 2024. Unlike in the United States, you have a currency now at 109 that's quite cheap and attractive, particularly relative to selling into China and to Asia. So yes, there's been a reduction in people's growth expectations. And I'll just use again Morgan Stanley, but Goldman Sachs has said basically the same thing. But Morgan Stanley cut their 2022 European GDP from 3.9 to 3%, and 2023 from 2.8 to 2.3. I just want to importantly contrast that for folks. The 5-year average growth for Europe, 2015 through 2019, so before COVID, the growth averaged less than 2% in Europe, okay? So the 3% that Morgan Stanley came down to on Friday, so already kind of pricing in all the stuff that's happened over the last couple of weeks, is well above the 5-year trend growth rate. So I think this is the important thing that we need to keep in mind. Similarly, in the U.S., Mark Zandi of Moody's, who's a well-respected economics guy, cut his U.S. growth number for 2022 from 3.9 to 3.7. 3.7. I mean, the U.S. average growth, real growth from 2015 through 19 was 2.3. So we are well above the pre-COVID growth rates. And I don't expect that oil prices at these levels are going to change that dramatically. I would imagine they're certainly already in the forecast of Morgan Stanley and probably Moody's as well. And here's a couple of statistics I think really tell an important story. In the US, the percentage of GDP that is used to purchase energy is roughly about 4%. Okay? The average from the 2010 to 2019 period was roughly 4 to 5%. The peak in the late 70s was 6%. Okay, so again, we're not even close to the levels that pertained in the 70s and early 80s. And we're basically going back to the pre-COVID kind of spend on energy. That's the national account. That's the GDP account. Individually, so the consumer, right? Talking about consumption, reopening, as you pointed out. The U.S. Percentage of personal consumption spent on energy is roughly 3.5%. Okay, which is again the level that was used in 2015 to 2019. We've kind of recovered that level after going much less with COVID because nobody traveled. To put that in context with the peak of the late 70s, the peak was over 7%. So we're half in terms of personal consumption expenditure. We're half of what we were spending in the 70s. So the idea that we're going back to stagflation is, or inflationary periods like the 70s, I think it's just, frankly, I think it's lazy thinking. It's not even doing the most basic of work to go back and compare the current environment to the 70s. And you realize very quickly that we're nothing like the US economy of 2020 is nothing like the US economy of 1979. And so the ability of people to deal with gas prices at $4 or $5 for a limited period of time is perfectly good. It's maybe not politically great for Biden and for the Democrats. It generates a lot of headlines, but we are at 3.5% of our personal consumption spend on energy versus a peak of over 7%. So barely halfway. So to me, as I said, the reopening trade is much, much bigger and much more positive in terms of what it means for lower than expected inflation through the unsnarling of supply chains. I would point out that the Fed's Global Supply Chain Pressure Index just had its first back-to-back down months since September and October of 2020. So January and February were both down months on that supply chain pressure index. So supply chains unsnarling, people going back to work, opening up, and therefore lower than expected inflation. Now, and obviously that, now you're probably going to have some inflationary hit a little bit from the gas prices and things. So maybe it's not quite as dramatic as I was expecting, but you have on the other side, better than expected growth. And again, I point out the record low unemployment in Europe, the good job numbers in the US, the fact that the service sector is just starting to reopen across much of the United States. Many of my friends who are outside of New York tell me, well, Jay, we haven't had restrictions for months where in XYZ state or city. Yeah. I'm sure that's true, but California, New York, Pennsylvania, New Jersey, etc., a large part of the country has been operating under significant limiting factors relative to COVID, and they are all going away. And so to me, that is a good sign. So I would just finish up by saying, a lot of people talk about unanchored inflation expectations and the Fed has lost the plot and behind the curve, et cetera. I think fair enough, the Fed is behind the curve, but inflation expectations show no sign, repeat, no sign of being unanchored. If you look at the 2-year inflation break evens, if you look at the 3-year, the 5-year, they're all right around 3%. And my view, as I've said before, is that I think the Fed is going to be happy to get to inflation at 3% and declare victory. And it's not going to want to tighten so far that inflation gets to 2% and things break. And when you put together the history of market responses to conflicts, and the folks at LPL put together a really nice table going back to World War II. The issue is not the depth and severity of the conflict, but whether or not it creates a recession. If it creates a recession, then markets tend to be down 3 months, 6 months later. If there is no recession, markets are flat after 1 month, up after 3 and 6 months. And I don't think there's any chance, virtually no chance. I mean, there's always a chance, but I believe less than a 10% chance of a recession in the United States in 2022. The Fed's own recession indicator is at less than 10%. So again, it's not just Jay Pawlowski, it's the Fed as well, which runs the data on this as it's a recession indicator. You can look it up. It's available, easy to find, is at less than 10%. So no recession in a pretty well discounted Russian-Ukraine conflict, and markets that are, clearly selling aggressively. I think it's the time you have to kind of bite the bullet and take the pain and prepare for better days.
Yeah, no, and what you said makes total sense, and it's especially important to hear that in a day like this, because I especially like, and I'll make sure I put that on my notes tomorrow, the numbers on the percentage of energy expenditure, because some people in the market are saying that, okay, to Russia's advantage, they have kind of forced a margin call on the market, by forcing energy prices up, which is kind of the sanctions backfiring. And even if that's the case, as you said, the impact is not that great, correct?
Well, yes, I don't believe the effect beyond the day-to-day market action is going to be all that significant. And I think it's important to note that for the most part, we should be longer-term investors. If you're trying to trade this, I mean, that's a skill set that I do not have. And so I don't try to trade these types of moves. They're super aggressive, super fast, and very whipsawed, like in up and down. So I tend not to try and do that. And to me, it's a situation where, yes, Putin may benefit from higher oil prices, but remember, Russia is not being able to sell. No one is buying. And that's before, formal government embargoes or shut-ins. So right now, today, Europe is available to take Russian gas and oil. U.S. is too, but 70% plus of Russian production is not being bought. And by the way, Russia does not have significant storage capacity. They they pump it and they sell it. And so the thinking is from, again, folks who should know more than me, is that within the matter of days, if not weeks, if not days, Russia is going to have to start to shut in its own production because they have no place to put it. And again, it just reinforces to me that the timeline for President Putin is very short. I think in a matter of weeks.
Yeah, no, those are great points. And what I said, about this margin call story was to agree with you that even with higher energy costs, the impact on the Western economies is not so great. because people do not spend that much on oil, on energy. I mean, as they once used to. What you
Absolutely
said about
correct.
the 70s. Yeah.
Yeah,
So
absolutely correct.
now let's go on to Europe. I mean, what does, I mean, it's one of your favorite regions, and we agree. What does all of that mess do to their, energy transition story? So we can talk about that. We can talk about KRBN. What you think the EU is going to do, to subsidize, the consumer in those difficult times, and until they can, find a substitute for Russian oil.
Well, I think they're moving very, very aggressively. There was, reports today that they're going to be out, reduce their dependence on Russian energy by 80% in the next year. So, the die has been cast. And again, that's why I say I said at the onset, the idea that this is the outcome that a master strategist would seek is just about as far from reality as one can imagine. This is an absolute horror show for Russia and its future as a thriving economy and country. And so I think that the push for energy security can be dovetailed with the Green Deal and the next gen. And so you're going to allow Europe to kind of hit two goals with one effort, right? The effort is going to be to sharply reduce reliance on Russia, and at the same time do that by accelerating the adoption of renewables. And so to me, that's a very potent, powerful, and smart approach, which will deepen Europe's integration and reinforce the idea of the three poles, the tripolar world, because it will effectively mean that Europe will be much more self-sustaining in terms of its energy requirements. And so I expect, what's surprising to me, frankly, is, and you brought it up, is KRBN, which is the carbon ETF, the bulk of which is tied to the European ETS, emissions trading system. And that has been absolutely decimated over the last week and a half or so. And I frankly have been quite surprised by that. I reached out to the Crane people directly, the folks who provide the ETF provider. And, our discussion with them was that there were rumors going around about, because of the price of energy going up so fast, that there was going to be some sort of cap or cessation or force majeure declared in the carbon market in Europe. The Crane folks said that they have no sense that that's likely. And clearly, given that KRBN and the emissions permits have collapsed in price, that risk should be off the table, because it's no longer a concern that the permits are rising as rapidly as they were. And I think that what's happened is that a number of large holders have decided to exit. And I give you today as an example where KRBN opened in the first 15 minutes down 9% after already having come down from 55 to 40. Went down to 36 or something like that today. But the entire average daily volume of about 800,000 shares was traded before 10 o'clock this morning, and ended up being a day where it traded 3 times the average number of shares, over 2.5 million shares thereabouts traded in KRBN today. So to me, that's emblematic of a large seller, price insensitive, right? Doesn't care about the price, just wants out. And in a thin market, when you hit the bit, when you hit a block 800,000 shares in 1.5 an hour, you're going to drive the price down. And so that's what's happened. We actually, timing, one could argue, may not be a Pulaski forte, but we did last week. We have our monthly update of our models, as you know, and we added to KRBN in our model portfolios. We had taken profits several months ago to a good effect, and still kept a core position because we believe in the story, the carbon story. Carbon has to be priced at a high level to facilitate the transition to renewable energy. And so we decided with the sell-off over the last week and a half to go back and add to it last week. And so obviously late last week. So obviously today was not a wonderful day for that position. And there were others. We talked about EUFN. I think a screaming opportunity for anything beyond, let's say, a 2 to 4 week holding period, trading at half of book. To me, just crazy price action. And then Jets in the U.S., the reopening trade, another example of something that's just been absolutely pounded, down again 10% today on 2 to 3 times the average volume. And there, I guess, makes a little bit more sense because you can say, well, oil prices up, jet fuel up, margin squeeze. But again, I would go back and say, well, what about, planes being full? What about people traveling? What about people traveling internationally? All that, I think, is going to open up in a big way in the next couple of months. And jets at these prices seem kind of crazy to me. But I think to go back to your point about renewables and Europe happening there, I mean, this is all going to drive that process, ever more quickly. And that seems to be the way the policymakers are using it. And another good phrase, Roberto, is, never let a good crisis go to waste, right?
Yeah.
And the European policymakers, people always moan about Europe and it's so slow and, convoluted and all the rest of it. But Europe tends to respond well in crisis.
Yeah.
And I think they responded well in COVID, and they're responding well here. And so to me, again, on a strategic view, Europe is going to emerge from this much, much stronger. And so for investors who have 2, 3, 5 pension funds, 7-year type of views, I think adding to Europe at these levels is very, very compelling.
No, absolutely. And given everything you said, does it make sense to add ICLN again? Because with oil at these prices, it makes sense. I mean, probably every renewable project makes sense. So I mean, you think
we don't have it in the model currently. We have had it in the past. Our position for the most part in Europe in regards to renewables is with KRBN. So that's where we're at the moment. But yes, I think renewables in general, I mean, you can look, I mean, the challenge is, frankly, that most of these kind of thematics, whether they're disruptive tech or climate or, whatever the theme is, they're not core to people's portfolios. And so when uncertainty rises, people tend to simplify their portfolios. Yeah. And so they sell these things. And for the long-term investor, that's an opportunity to buy. But, then people get scared by the price, the price action, and they just watch. LIT is a good example right there. In the renewable space, right? Electric vehicles. I've written 2022 is going to be the year of the EV. Every chart you want to look at, and even current purchasing orders, EVs are rolling off the lot as quickly as possible, as quickly as people can make them. And yet, LIT was down 4 or 5% today, and is down probably 15% over the last 2 weeks. So that's the issue. Do you have the staying power to stomach, drawdown of some order of magnitude, to have positions in the thematics which are not core to many people's portfolios and thus are susceptible in environments like we're right now to being just tossed overboard irrespective of price. And to me, I think one of the advantages we have at TPW Advisory is that we do have our TPW 20, thematic model. So we are very focused on the thematic side. It's a natural progression for a global macro guy like me who thinks about politics and policy as part of our global risk nexus to think about thematics. And that's why we introduced the TPW20. And so here's my point. When we went back and looked at the performance of the TPW20 last month, 16 of the 20 positions outperformed ACWI. Okay, so that tells me that the selling pressure on the thematics is ebbing, notwithstanding a day like today where things get whacked.
Yeah.
But in essence, in general, these things, the TPW20 underperformed its index in December and in January pretty badly because this stuff was just getting pounded. This month, in February, it outperformed. And 16 of the 20 names, ETFs, outperformed the benchmark. So I think the selling pressure is ebbing. And one of the things we did, to kind of segue into some of the changes, in addition to adding to KRBN, one of the other things we did was we started to go back into the disruptive tech space. Because I believe that space has already been through its bear market. It peaked over a year ago. Many thematics are down anywhere from 50 to 70%. If I'm right that the Fed, risk of the Fed breaking things and causing a recession is not going to happen, and we do migrate after we get through this crisis period to a above trend growth path that I've been talking about for some time, I think the disruptive tech and thematic space is going to be the big winner. The challenge is going to be, can it move up while the big cap tech, the FANGs, are continuing to gradually derate because that above trend growth path means higher long-term interest rates, which will then cap the upside of the FANG type names. And so that's the kind of the threading the needle on the thematic space. But we did make our first foray back into disruptive tech last week in our global multi-asset portfolio. So that's, something I think people should be, again, keeping in mind. How do you position and protect yourself defensively in this type of an environment, but how do you opportunistically take advantage of it in position for anything, again, longer than a month or two? On a day-to-day basis, you'd be saying, I'm long only. So long only global multi-asset portfolio, you'd say, I don't want to touch anything, right? Stocks are getting crushed. Fixed income is yielding no returns. Cash, negative return in the US, right? Cash yields nothing. Inflation's 4 or 5%. Immediate 4% markdown. Commodities are great. We own a lot of them, but they're on a spike. They have the most aggressive backwardation in the history of the commodity index. So you don't want to be buying that. If anything, you want to be selling that, as I posed to John Farrell on Bloomberg this morning, because he was pushing me on this stuff. I said, John, would you rather be buying EUFN at half of book or energy that is on a spike and has had a 40% appreciation in 2 weeks? I would much rather own EUFN and buy EUFN here than I would buying energy. The time to buy energy was when you and I were talking about it, 6 months ago, 9 months ago, 12 months ago. You know very well. We've been very long the energy complex, and we still have the bulk of it, though we also took profits there a little bit early because we didn't know the Russian invasion was going to happen. But in January, we took some profits on XLE. And so that's the business of, if you want to stay in the business and stay in the positions, and if you're not an aggressive trader or a long short person, you want to be well diversified, as we are, across assets, well diversified across regions, as we are, and well diversified across sectors and segments, which we are, though we have a clear bias to value and to cyclicals. And so that has allowed us to kind of ride through this volatility with relatively okay performance. We outperformed our benchmarks in both models last month. So, that's kind of how you put the portfolios together that really determine whether or not you can be a holder and an investor in the true sense of the word, as opposed to a trader. And there's nothing against traders. Again, you have that capacity, then more power to you. That's just not my game.
Mhm. Yeah, and why don't we go on to the allocations? Where we stand on that sense. I mean, you kind of started already. So where would be the portfolio now?
I thought we just did that, Roberto. But let me do it. Let me kind of look at it slightly differently. We are. We didn't make any asset allocation changes last month.
Okay.
Or last week. So we're still overweight equity, deeply underweight bonds. Let's just stick with the equities. We're overweight equity, underweight the U.S., underweight growth, overweight non-U.S., which has taken a hit again, obviously with Europe. We have a big position in China, which has been, okay, not great. I would say that China is the best performing over the past month of any of
markets,
the three, Europe or versus the U.S. China is down less than Europe or the U.S. in the last month, so it's not hurting us on a relative basis. We initiated a position in January in Brazil. That's been great. We hold that. So that's kind of, we have a position in small caps. We have some thematics I touched on, but that's effectively the equity side of the global multi-asset model. We're deeply underweight fixed income for the view that I just expressed. I think we're in a strong growth environment, better than people are going to, better than the pre-COVID. I mean, I think the best way to put it is, I believe that the environment we're going into is going to be a growth environment, is going to be better than the pre-COVID period 2015 to 2019. If that's the case, interest rates are going to go higher, particularly at the long end. So we want to be underweight fixed income. A lot of our fixed income exposure is in Asia. And that has worked out reasonably well, particularly our China government fixed income position, which has been probably the best performing fixed income market in the world so far this year, amongst the major markets for sure. And then we're overweight commodities across the board, from energy to precious metals to industrial metals to agriculture. We have positions in all of them. I just wouldn't be buying them right now because I think they're all super extended. Again, whether you look at wheat, the RSI on the wheat ETF is well over 80. The RSI on GSG, which is the main, the Goldman Sachs Commodity Index ETF, is like 84. You're not supposed to buy things with their short-term RSI well over 80. So, you can hold them and just accept the fact that the price you see today is not probably the price as soon as things change on the Ukraine. Oil's going to come down, wheat's going to come down, the whole thing is going to drop, significantly, but the trend is still up, right? Because we're in a strong global growth environment. So the trend in commodities, I think, is still appealing. And then on the thematic side, as I mentioned, we're starting to tiptoe back into the disruptive tech. We continue to have big positions in uranium, which has done reasonably well, kind of offset KRBN a little bit. We added to KRBN, as I mentioned. Our positions in other kind of less volatile thematics like demographics, infrastructure, aging, things of that nature have kind of helped balance the volatility of that model. And so we're pretty comfortable there. And as I said, if I'm right, that not only did Russia's invasion of the Ukraine take the near-term risk of aggressive Fed tightening off the table, It also means that the risk to the better than expected growth outlook for the next several years has also, I believe, been taken off the table. Because if the Fed was going to tighten such that we had a recession, then obviously you can't have better than expected growth. You have a recession. If that's not, well, if that's no longer the case, and we can sustain through this period of uncertainty with higher energy prices, which I think we can, given the numbers we talked about earlier, then we have that outlook of a better than expected growth profile. And should that come to pass, I believe the disruptive tech space, the ARC space, is going to do very, very well, because we're getting ever closer to the time when those companies are able to monetize. And you move from price to revenues to actually reporting net income. And I'll just end on the Tesla side, right? I mean, Tesla was, a couple of years ago, people thought it was a complete fraud. At $200, it would never earn a profit. And then last year they made $5 billion and it traded over $1,200 a share. And so yes, now it's at $800 a share. But to me, Tesla is really a tripolar world company. And I tweeted this out earlier today because it just got the okay to start production in Germany.
Germany, yeah.
So now it has a production platform in China. It has a production platform in the Americas, and it has a production platform in Europe. It is very well suited for the world that is coming and is unfolding as we speak, and that is the tripolar world.
And to finish, given that you talked about tripolar, we have 3 minutes. Anything, and especially when you speak to your colleagues, like the Morgan Stanley call, what are you hearing on China? Because, it's been a big point that this was going to be, a glide path here in China. Is that shaping to be the case? I mean, of course, the Chinese are very pragmatic and, they want to keep kind of a distance from Russia without, applying sanctions. How are you seeing things from there?
Well, they're having their 2 sessions meeting now, which is very important. And that kind of paves the way for the fall meeting when President Xi is likely to get his 3rd term in office. We have used the term China glide path 2022, and I think that continues to be the case. Not going to really be a significant upheaval, whether political, economic, or military. People talk about what does it mean for Taiwan, what's happening in Ukraine. I think it's a glide path year. They set the target for growth of 5.5%. On the one hand, the lowest growth target since 1991 or something. On the other hand, second biggest economy in the world growing at 5.5%. That sounds pretty good to me. Pretty darn good. And policy continues to be easy. One of the things why we're still overweight non-US is that the policy mix outside the United States is much better than the policy mix inside the United States. The US has significant fiscal drag this year. The US has the Fed tightening. Europe, as we touched on, has fiscal stimulus, and the ECB likely to do nothing. China has the PBOC easing and the capacity to use whatever degree of fiscal stimulus it needs to achieve its target. And those are the things that make us think that on a asset allocation basis, we want to be in the markets where the policy mix is more conducive to growth and to earnings growth, and thus to equity appreciation. And that to us is outside the US, not inside the US. So China, I think the surprise is going to be that China has a big role to play in the negotiations with Ukraine and Russia. They're the trusted third party. Ukraine has said it's okay with China. Clearly, Russia is okay with China. And it would be a great stroke for President Xi to be seen as kind of a global peacemaker, which is the role traditionally of the United States. But the U.S. can't get in those, I don't think can lead that negotiation, because Russia will be less than happy to have that happen. And I really think that Russia runs the risk of becoming a vassal state to China, right? And so it probably really doesn't want to have that happen. And if China can give them some cover to make a deal with Ukraine, that actually allows Russia to not become a vassal state. And I think in the general scheme of things, China's probably okay with that because they know they're still going to be able to use and buy whatever energy they want from Russia because no one is going to touch it for a period of time.
Yeah.
Certainly not to the extent that Europe has been taking down Russian energy exports for the last 5 years. So that's going to go to China, and they'll be fine with that. So I think the what I'm looking for is continued policy statements, positive policy towards growth in China, and China to play a geopolitical role in the settlement that I think is likely to come in the near term between Russia and the Ukraine.
That's fantastic. So we just went past the mark. So fantastic. Of course, a lot has changed, and it was great talking to you today because you always keep cool, and you look through the noise, and it was great. And I already received some feedback here. It's great to hear your views on a day like that. When people are panicking and thinking the world is going to end. So fantastic. Thanks again. And yeah, look forward to speaking in 2 weeks exactly.
Great, and thank you, Roberto. It's always a pleasure to engage with you and the folks of Ohm Research and all the folks in Brazil. And yeah, keep cool, keep calm, carry on. Right, that was our phrase way back like a year or so
back,
ago.
yeah.
And every day is a good phrase to have top of mind. And don't obviously focus on protecting one's portfolio, but also don't lose sight of the opportunities that are being created when people decide they just want to get out and they don't care what the price action is. That's an opportunity. And I think those opportunities are becoming quite prevalent on the ground in the different equity markets around the world. So thank you, and we'll see you in a couple weeks.
Thank you. Thanks again.
Bye-bye.
Cheers.